Hello and welcome to Livewire's listed series for 2024. My name is Chris Conway and today I'm joined by Sebastian Mullins, who is the head of multi-asset at Schroders Australia. Today, Seb is going to be talking to us about the opportunities he is seeing in the current market environment. Seb, thanks for joining Livewire.
Thanks for having me, Chris.
Seb, before we talk markets, I just wanted to place the product we're here to talk about today. It's the Schroder Real Return Managed Fund. It does have some very unique elements, one of which is a focus on objective-based returns. Can you just explain what that means for investors and why it's important, particularly right now?
Sure, Chris. Well, I guess the difference is most other managers will have a benchmark, and their job is to outperform the benchmark, but irrelevant if that benchmark goes up or down. So an objective-based portfolio really focuses on delivering absolute returns throughout the market cycle. And for us, with this fund, in particular as Grow, for us, it's trying to align our objectives of the fund with the investor objectives, which is effectively to earn a real return, to return over inflation, and protect capital to the downside. So we try and ensure the portfolio meets those objectives and gives a positive absolute return over time above inflation.
Seb, given that focus, what type of investors will typically use this type of product?
It's a real mix. So because it is focusing on limiting drawdown and capital preservation, it's quite apt for a total portfolio solution for someone in the pre or post-retirement phase. But that doesn't mean it's just a loan for them. It's actually a nice slice to have within a portfolio that can help someone, even in the accumulation phase, move that asset allocation around. So because we're moving our asset allocation between equities and bonds, depending on our forward-looking view, an allocation there can help move the allocation around for the investor without having to actually change their asset allocation themselves. So for us, we think it's a nice allocation to any investor, depending on how risky they want their overall portfolio to be.
Seb, there are a few multi-asset ETFs on the ASX. Of course, Grow is one. What are the benefits of multi-asset, particularly in today's current market environment?
Well, I guess the important thing about multi-asset is it does actually give that diversification benefit throughout having a broad breadth of asset classes they can invest in. And because it's quite flexible on how we can actually choose each asset class, we're shying away from the ones that have probably vulnerabilities within them and allocating towards one that are quite attractive, either in return or capital preservation. So for us, having that ability to move around quite flexibly across a broad universe is quite important. And I think more important today is that if you think about the post-GFC period from 2008 up until, say, 2020 during COVID, you had a very low volatile market. Inflation was very low, rates were low, equities only went up. That's all that happened, very low volatility. Since then, volatility has risen, both macroeconomic volatility and asset price volatility. So having that flexibility and able to go long or away from asset classes that are attractive or not is far more important given that increased volatility.
Seb, let's talk about where the rubber meets the road. Let's say I was a client, I walked into your office and had $1 million to give you to invest in Grow. What would those allocations look like as it stands today?
Well, right now, we're quite well diversified. So we have, it's not always like this, but we have around a third in equities right now, a third in sort of diversifying assets. I can break that down a bit later. And the rest is sort of in what we call defensive allocations. So things like investment grade credit or sovereign bonds. So that mix is quite well diversified. But most importantly, there's not much cash left in the portfolio. We had quite a bit of cash during 2022 because that was the only way to defend against asset prices falling effectively. But we've redeployed most of that cash now. So we're kind of fully invested, but a third in each of those sort of sections.
So just to pull on a thread there, Seb, the low cash amount is a reflection of the fact that you're bullish on markets, broadly speaking, right now, or more bullish than you were previously. Is that fair?
Correct. We think assets will outperform cash over the medium term.
Great. I want to focus in a little bit more on the equities tilt. So 24% of the portfolio is in global and 6% is in Australian equity. So again, about a third of the portfolio. Again, is that a reflection of how you're feeling about particularly equity markets right now? They're near all-time highs or at all-time highs?
Yeah. So I guess, if you think about the previous allocation of, say, the last 3 years, so the fund can have quite wide ranges, but the last 3 years it's been between 15% total in equities up until around 40-45%. So right now, 30-35% in equities means that we're bullish, but we're cautious on a pullback short term. So we want to have some dry powder to deploy if equities pull back. Like you say, close to all-time highs in most markets. We think the fundamentals of equities are improving. We're seeing things like growth in the US hold up quite well. The view that central banks will start cutting rates soon will support markets, but they're getting pretty lofty now. So we're probably holding 35% equities, waiting for a pullback, which would then be a buy on dip opportunity to increase to, say, 40 or 45%.
And just a follow-up question there, if I may, where would that extra allocation likely come from if you were to up the allocation to equities?
Well, we had a big allocation to credit, both in investment grade and high yield credit. If you remember in 2023, even spreads blew out quite dramatically in that sort of September period, giving great entry points to buy credit. Since then, credit spreads have tightened dramatically overseas. So mainly in the US, credit spreads have really, really tightened. So for us, we're not expecting those credit spreads to widen or credit to sell off, but lots in the price. So if we think there's going to be subsequent upside in assets, we'd probably prefer selling, say, global IG investment grade credit to fund allocations into equities because they have more upside potential. That's probably the rate of play. And even more recently, we have been selling IG global investment grade credit to add some cash to the portfolio, waiting to deploy into equities on the pullback.
Let's focus in on fixed income if we can, Seb. Regular fixed income, if you want to call it that, is about a third of the portfolio. High yield around 22%. How do you make those determinations in terms of the opportunity set and why is it placed that way at the moment?
Sure. Well, I guess our process has multiple layers. And the first one is what is our forward-looking 3-year expected return on these asset classes? And given our conversation on downside protection, we do then caveat that with what is the probability of loss for each of these asset classes. So based on that, you want to maximize your return for lower probability of loss. That gives us the overall sort of risk of the portfolio. How much credit, how much equity do you want to have? So that's the first step. When it comes to then determining within that how do we want to allocate it, we use what we call the VCL framework, which is what value are we seeing in those asset classes? Where are we in the cycle? The beginning of a cycle, towards the end of a cycle. What is the liquidity environment, whether it be central banks cutting rates or positioning in the market, et cetera. So that would make us decide within that risk asset how much to allocate to either high yields or IG or Australia or US, for example. So that's how we sort of look at the world. When it comes to our current allocation of fixed income, as you mentioned, and I kind of alluded to in the previous answer, spreads in global IG and high yield have tightened quite a bit, whereas spreads in things like Australian credits, both in your investment grade credit or even your subordinated debt, like your bank tier 2s, for example, are relatively wide compared to their own history and relative to the US's history. So we prefer relative value within that space. We've been selling US, buying Australia. So it might not change our overall allocation to credits or high yield, but how we play that will change in the portfolio based on our views.
So it sounds like Australia is preferred at the moment in terms of some of those allocations. Is there any other geographies that you're liking?
Sure. So in terms of geographies, the spreads are most attractive in Australia.
Yep.
So we do prefer Australia over sort of global when it comes to credit. If you're thinking about the US, in particular within the US, corporate credit is very tight, but we're seeing value in what's called securitized credit. So an example would be a mortgage-backed security. That's guaranteed by the government, AAA rated in the US. That has a higher spread right now, so yield above sovereign bonds, than corporate credit does in the US for a 3-notch upgrade in credit quality. So for us, we're preferring moving with that from corporate to securitized in the US. Outside of, say, developed markets, outside of Australia and the US, Europe does look cheap. So we do have some European investment grade and high yield credit because they have wider spreads in the US. So it's trying to pick out different countries within the asset class mix that show the best value and subsequent returns.
So I want to talk about some of the smaller allocations. I'll just make sure I get them right here. Commodities, Asian credit, EM bonds. A little bit more exotic. Are these the areas of the portfolio where you try and chase a little bit of extra return or add a little bit of spice?
Well, I think that, first of all, that shows the diversification we have, right? Yep. We're able to go for a large breadth of different asset classes and markets. Now, of course, everything in the portfolio we expect to add to returns, but those asset classes in particular also add diversification benefits. Yep. So if you think about, you said Asian credit, for example, most funds will allocate to Aussie credits, which is mainly the big 4 banks, give or take a few other corporates. Global credit is mainly the US, so you have some concentration risk there, even with the global and Aussie mix. Throwing in some Asian credit, now we're not talking about Bangladesh or some smaller countries, we're talking about Hong Kong, Taiwan, Korea, big companies, investment grade corporates, but diversifying away geographically from the Australia-US bias. And because they're less, owned over here, the spread relative to credit rating and duration is quite attractive as well. So that's diversification. When it comes to things like commodities, again, showing the breadth of our asset allocation universe, we think that's an asset class that should help the portfolio as a hedge if inflation sort of spikes up again. It really helped the portfolio in that 21-22 period where inflation was rising. That was one of the few asset classes that actually was positive in 2022. So having those asset classes in the portfolio is beneficial from a diversification standpoint, but I think commodities is the last asset class that hasn't repriced for the soft landing or no landing scenario. So expected return is positive there, but diversification benefit as well.
Seb, another question without notice, if I may. Obviously with multi-asset, you're covering a lot of ground. You sit at the head of that and you've got to make all the big decisions, shall we say. But can you give us some insight into who is supporting you and how you make these decisions?
Sure. Well, I guess this fund is managed by the Australian team. We're based here in Sydney. We're an experienced team of about 5 or 6 professionals, average year 20 years experience. But we make the asset allocation calls. Now, we work for a large global firm, so we do have colleagues around the world that help feed into that decision-making process, but ultimately we have final say. So for example, there are 130 multi-asset professionals around the world. If I want to call up someone, say in China, and ask what's happening on the ground, we can talk to our colleagues in Shanghai. That helps us make better informed decisions at that asset allocation level. Now, at the same time, we have a whole bunch of bottom-up stock and bond picking teams globally that can give us information from the bottom up. So for example, we might have a top-down view on recession, but asking the equity analysts, what are you seeing in the earnings report? Is there any sign of weakness? They might come back saying no. And that's powerful information for us to help with our asset allocation call. But at the same time, we're doing top-down asset allocation, but we also have bottom-up stock and bond selection within the portfolio. So for example, the Aussie equities in Grow are managed by the team here. Same with our Australian credit, both investment grade and higher yielding, picked by our team here in Australia, our credit team. So you're kind of getting the best of our top-down asset allocation calls, but also that bottom-up stock and bond selection from our global teams.
Seb, last question. I assume you have a bear case, a bull case, and a base case for the next 12 months. Assuming your base case plays out, how do you expect markets and therefore your allocations to change over the next 12 months?
Sure. So I guess the way to phrase it is, if you asked me 3 months ago, we'd probably say we were bullish on short-term rallies and equities, but more fundamentally questionable or cautious over the medium term.
Yep.
We're seeing that now sort of turn 180. So we're seeing signs of improvement in economic variables in the US, sustained earnings in the US, for example. So we're probably more structurally getting more fundamentally supportive in equities, but everyone's in the same boat. So structurally positive, short-term negative. That's why we're raising cash to buy equities. So if our view plays out, we might get a better chance to add to equity positions. And as I mentioned before, selling credit to buy equities. I guess if we're wrong, there's sort of 2 bear cases. I mean, one would be we do actually have a recession and all those models turn out to be true, in which case you'll have both equities selling off and credit selling off, but your duration allocation is doing well. And the fund has things like US dollar and even Japanese yen as currencies to help offset those negative losses if you do have a risk-off environment. But potentially more tangible is if we go into the election cycle in the US and either candidate wins with conviction and gets both houses, they're going to spend. Both of them are going to spend, just depends on who they spend on, but that could be inflationary next year. So for us, if they spend aggressively because one party wins decisively, that could put the Fed back into play next year, which no one's talking about right now. Not our base case, but something to watch in 2025.
Seb, last one, loaded question. Is there a better candidate to win for markets?
I think there'll be winners and losers in both, so it really depends.
Seb, thanks for chatting with Livewire.
Thanks, Chris. Thanks for having me.
If you enjoyed that interview as much as I did, make sure to give it a like and don't forget to follow our YouTube channel because we're adding lots of great content every single week.